So let's talk about your funds. Share with us. So we got the big sort of a little bit of the big picture view, but let's share with us some of the actual structure of it and then your investment thesis in terms of the type of assets you're going after and the type of investments you're going after.
Yeah, it's an open-ended 506c, $100 million total raise. Um, as far as type of assets, so workforce housing, which we define that as the median income, meaning a certain percentage of the average rents. So as long as it fits that box, it doesn't necessarily have to be like affordable housing or subsidized housing by no means. Like those can be included, but the one we just closed on in San Antonio, 327 units, Class A. It's a Class A property in San Antonio because of it has some certain parameters that does have some affordable housing in it. Then that actually classifies as a workforce housing the way we've defined it. So we're targeting workforce housing assets, both debt and equity. Equity is the primary focus. Debt's more on the short term, like gap funding, gap loans, hard money loans. Otherwise, equity is it's the bigger focus. It's just we're much more cautious on who we partner with, from a long-term
I,
perspective. And that's been my
I see.
caution with folks for years. And I'm sure you're the same way. It's like, I mean, when you get in this business, there's a lot of people think single family and multifamily are the same thing. And in some instances, there's a lot of similarities, but it's a business and there's a lot of moving parts when you're buying a business. When you're getting a multifamily, you're buying a business. And
Right.
you don't know what you don't know. And the problem with multifamily is the things that you don't know that cost you can cost you big. And if you don't have the foresight to mitigate those risks in advance, it's not that may not be able to, traverse through those rough waters. You may not have the time. You may not have the time, or you may not have the liquidity, and definitely the experience. And at the end of the day, like that can be a painful lesson to learn. So we focus on experienced operators and partnering with them to provide them with the equity that they need to get good deals. A little bit, I mean, not quite as strict on the short-term gap funding, but definitely on the equity funding, we're pretty strict on who we partner with.
I see. And just for clarification, would mobile home parks
Yes.
be
Yeah. It's pretty
considered
much
as
any
part of
residential
your?
housing. I mean, not luxury, but pretty much. So single family, multifamily, and mobile home parks. Multifamily is the primary focus.
Gotcha.
Not really too excited about single family. We have one single family in the fund. I had a rental that probably would have sold, but it made sense for the fund as far as the returns it was producing, and it has long-term benefits. So we seeded that into the fund. But by and large, multifamily is the primary focus. But mobile home parks, I just haven't looked. I haven't been looking for those type of opportunities. But I mean, we both know people who are doing really well in mobile home parks. I'm interested. I just haven't really been looking at them.
Right. So I really want to focus our interview today a lot around fun. So I'm going to ask you questions just to dive deeper into
Yeah.
this whole fun war. And so what have you decided that, you're going to make your fund, not only focus in actual acquisition and, as well as I guess you coming at somewhat of a uh, GP position, some you come in as an LP position, some you come in as a debt lender. Like, what have you decided to do all of those things versus just one specific strategy?
Yeah. Well, we are doing one. Well, if you want to consider debt a completely separate strategy, then you can say two. The reason why we added the debt is if we have smaller balances, and small can be relative when you're talking about $100 million fund, but definitely want the ability to monetize those balances. And we come across opportunities all the time. Just, hey, I need $100,000, I need $500,000, I need 1.5 million for the 30 days, 60 days, whatever. We want to be able to keep the returns going, not just have it sitting there in the bank. But the uh, the reason why we structured it the way we did is for going after GP position. I'm not necessarily, you talk about LP and GP, which really in legal documents, we're just really, it's like class A, class B. It's not really GP, LP, but since most people know what we're talking about, the fund is structured in a way where we're always in a GP position. And if we're in an LP position, we're in both. And there's two really important reasons. So if you're doing a fund of a fund or thinking about doing a fund of a fund structure, and you do not have a broker-dealer license, and or you're not a registered investment advisor, and this is not legal advice, this is just paying lots of money to get legal advice, you have to thread a lot of needles. So there's all these laws. You got federal laws, security laws, you got state security laws. So you're really trying to thread these needles. And Reg D is an exemption. It's a certain exemption that you're filing on. Hey, you do these things, and you don't have to register with the SEC. And again, this is just how I understand what attorneys have explained to me, whatever it. But the other thing with broker-dealer and RIA, there's a lot of complications, and there's a lot of ways that I see these deals, pitched to me. I'm like, I don't know if that's compliant. I just want to make sure I'm compliant. So where I'm going with it is, I don't get anything above and beyond my fund. Like, everything is enjoyed within the fund. I don't get any kickbacks. It's not that I couldn't. I mean, you can generally do a lot of things as long as it's disclosed properly in your legal documents. But it is important to make sure that you're compliant with broker-dealer and RIA, because those can be pretty costly penalties if if you're not compliant and something happens, and then the SEC's all over you. So we thread that needle very carefully, and making sure we're following the proper exemptions, or we're exempt properly, which includes, I just don't get any kickbacks. That's why we sit on both sides. If we're going to be an LP, we're also in the GP. Cannot be passive, and that's just because I'm not a registered investment advisor. If you are, hey, you can do things differently. And I've talked with folks who they've gone down that path. You just typically either want to be an RIA or you don't. And this may be a little too high level on what most folks would be interested in, but I do encourage anyone that's interested in fund of a fund structure where you're investing in other people's deals. You have to understand, these are the questions you want to ask a securities attorney, because you just want to make sure you're compliant. The SEC doesn't care if you're a billionaire, if you're a millionaire, or you just got started and you're trying to grind it out. Like, they will absolutely come down on you like a hammer if you violate these things.